All right, it's probably going to take me like 7-8 minutes, and then we can just turn the lights on and do a bunch of questions. All right, who am I? Spent 6.5 years in the Army, then built 2 companies here in Raleigh, sold those 12, 13, ran a bunch of product growth teams at Facebook and Snap, started Full Tilt Capital with Jason about 2.5 years ago, made a bunch of investments, and we saw 2 trends. We saw a bunch of talent from both the founders and then their top teams starting to go into the blockchain space, and then we saw a bunch of the money, right? So a bunch of investors started to invest in the space, and so when we first started investing, there was somebody who had told us, follow the talent and follow the money, and so that's what we did. And you heard Jason talk about us starting to build those crypto facilities and kind of get into it. What I'm going to talk about today is the history of a security. So since the beginning of time, assets have had owners, and if you go back to the most or the first periods of history, people would write down, whether it was on stones, tablets, etc., who owned those assets. And so over time, that evolved, and we kept writing it down in different formats until we got to what you see here, this analog era of securities, literally a paper share certificate. And this paper share certificate is literally something called a certified security, right? So it certifies that you own that unit of ownership in an asset. And what people used to do is in the, what I call historic peer-to-peer transfer or transaction, they would have to find each other and say, I would like to sell you my ownership in this asset, and you would give them currency. There was no marketplaces, there was no exchanges, etc. In 1602, the Dutch East India Company said, you know what, we probably should figure out one location for anyone who owns our stocks or bonds to come together and be able to exchange those stocks and bonds. And so they created what has eventually become the Amsterdam Stock Exchange. And so in 1602 was the first time that we have any sort of historical track record of what is now known as a securities marketplace. But it was for one company in one location. And so the issues obviously are there's not a lot of assets that were being traded there, and you had to physically go there. And so from 1602 until about the 80s, 1980s, we continued to create different marketplaces, right? Literally starting with single company marketplaces in different geographies around the world to eventually creating stock markets where you could go and buy and sell multiple assets at the same location. And so the way that we did this, as humans tend to do, was in a very barbaric nature. It's something called the open outcry method. So you guys have probably seen where people stand and yell and scream at each other, bids and asks, and eventually they've yelled so much until they reach some sort of consensus between 2 people and they consummate the transaction. And so having people, whether it's yourself or your broker, physically go to a single location to transact these assets, again, isn't very efficient. But when compared to the 1600s, where you could only go to one place for one asset, at least now we can go to one place and transact multiple assets. But there's still a huge issue when it comes to the efficiency, the investor participation in that marketplace, etc. During the 80s, electronic trading becomes popular. And so what electronic trading basically says is, rather than us buying and selling these pieces of paper, which has always represented the ownership in the asset, we're going to allow technology to let us more efficiently trade those securities. And so what we basically created was a representation in an electronic format of the paper. But today, if you were to buy shares of Apple, that transaction is settled through something called the DTC. But you can still call Apple and say, send me my paper share certificate, right? You will receive a paper share certificate because that is ultimately the unit of ownership in that asset. But this electronic version becomes really popular because now I don't have to physically go to the New York Stock Exchange or other exchange. My broker doesn't have to be there. I can use a computer. I can trade multiple assets, and I can be anywhere in the world. But part of that problem is there's a lot of regulatory hurdles and financial hurdles to participate in this Western-centric financial system. So if you think today, for a international investor to be able to participate in what we consider a free market, they've got to have a certain level of wealth in most countries, they've got to have a bank account, and they've got to have some sort of brokerage account. And then and only then are they allowed to participate in the Western-centric financial system. But of course we make it hard on ourselves, and the US stock market is closed more hours a week than it is open. It is 2018 and we have a marketplace that is closed more hours a week than it is open. This is fucking insanity, right? Just so I'm really, really clear. And so, what ends up happening is, just like when we went from the analog era to the electronic era, we saw this gigantic inflection point in the US financial system. More people could participate, more assets came into the system, there was better price discovery because of that larger investor base and free market, and ultimately it was a net good for both the issuers and the investors. So today what we're seeing is this move from the electronic era into the digital era, right? And so in this digital era, what this means is we get rid of the paper. Again, if you ask any company, they are digitizing everything, right? We don't fax things as much anymore. Well, some companies do, but they're dumb. And so, for the most part, we're going through and digitizing a bunch of different aspects of business, but the ultimate, or the core of that business, the ownership units, are still based on paper. And what blockchain technology allows us to do is basically trade that paper in for a digital share. So rather than have the paper share, we have a digital share. That digital share is kept on the blockchain. It's used to, an individual can hold it in their digital wallet, where now the digital wallet basically becomes that new brokerage account. I don't have to have a bank account, I don't have to have a brokerage account, I can just have a digital wallet. It opens up the investor participation around the world. Anybody who's got a Coinbase account eventually will be able to do this. And then also it creates a much, much more efficient process with lower costs, because what you're doing is you're removing middlemen from the system. Right? So today, if you want to buy and sell a stock, it's on a T2 system. What that basically means is it takes 2 days to settle that transaction, right? So people are always complaining about the settlement times for the Bitcoin network. Well, if you compare it to 2 days, we're doing pretty good, right? If you compare it to a private transaction, anybody in here ever invested in a private company and tried to do a secondary transaction? You literally have to go ask the company, can I do this trade? And the company says yes or no. Well, that process takes weeks, sometimes months to do. And so what we're doing is, by creating these digital shares, not only do we increase the settlement times, decrease the settlement times in a more instantaneous format, but also we're letting the code govern. So everyone always asks about, I'm going to skip through here to this piece, everyone always asks about the regulatory components of this, right? Regulators love this, and here's why. Today, if I own private shares in a company, I could come to you and I could sell those shares. You give me money, I give you the shares. Technically, you now are in possession of the shares. You should own the company, right? Or you should own those shares. Well, if I'm an accredited investor and it's a Reg D private placement, and I've now sold it to you as an unaccredited investor, I've just done something that's non-compliant. And so what regulators will do is they'll spend a bunch of time, money, and energy trying to figure out who we are, what we did, build a case, and then enforce on us. This can take years, 2 years, it can take millions of dollars, and the regulators are forced to be reactive in nature. And so companies have tried to step in and say, well, we'll just have everyone come ask us. Well, I don't really think the company should tell me how I can spend my money, right? And so what ends up happening is when the law gets written into the code, you take the regulators from being reactive and force them into a proactive position. What I mean by that is, once you digitize the equity, you're able to KYC, AML, and verify the investor accreditation of all the wallets. So you know that I'm an accredited investor, this is my wallet. And then you know inside of the security that the token itself actually has, this is a Reg D private placement, this was issued by this company, on this date, in this jurisdiction, etc. You get all the criteria. And then it knows who I'm trying to transact with. So if I try to do a peer-to-peer transaction, or I try to transact on an exchange, it knows who I am, what security I have, and who I'm trying to send it to. And in an instantaneous format, it's able to actually give us a thumbs up, thumbs down on whether it's a regulatory compliant trade. If it's compliant, it consummates the trade. If it's non-compliant, it rejects the trade and tells us why it rejected it. So all of a sudden, now that regulators can be proactive, they don't have to spend all that time, money, and energy trying to enforce all the time, and they can actually spend their time trying to be efficient, just like any technology company would be, and set the rules up front so that people are actually protected from themselves, right? In most cases, people are not trying to do things that are non-compliant. They either don't understand the rules, or they're just doing something stupid that, if we put the bumpers on, I think that we can prevent. And so obviously at Morgan Creek, we're incredibly excited about this. We think that, as the title says, we're going to tokenize the world. And And so I've recently come out and said, what something is a controversial statement, but I'll stand by it, that tokenized securities are a much, much more disruptive application of the blockchain than Bitcoin. And so when I first say that, a lot of people say, you know, you're crazy. Well, let's walk through the example. So Bitcoin, if it replaces all of the money, banknotes, credit, gold, and silver in the world, is $100 trillion. $100 trillion sounds like a big number. US global real estate market's $215 trillion. If Bitcoin does every single thing that people want it to do, it's only half the real estate market. That doesn't include public equities, private equities, derivatives market, etc. And so when you look at the market opportunity for blockchain technology is currency, right? Which I personally believe Bitcoin will be incredibly valuable there. But the bigger opportunity and where we want to spend our time investing capital is actually into these tokenized securities. And you know, what we say is the killer app of the blockchain is capital formation. And so that's what we're going to go do, and you know, we'll see how it plays out here. Any questions?
So are we open? Are you ready for questions?
Yeah. There's no questions, so we're done.
No questions. Hold on, we'll get somebody back here.
We have a lights on, I can't really see.
Oh yeah, let's grab some. Hold on, he's running back there to get the lights.
You can ask that question.
Hey, how's it going? My thinking with, particularly with tokenized securities, is do you see the market moving towards all these tokens continually restarting their own networks and bootstrapping blockchains from the beginning? Okay, so you see this as more of a, because it seems like a constantly redundant security infrastructure.
There's going to be one single global financial system that's going to run on a single blockchain that both regulators, issuers, and investors all agree on. Is that Ethereum? Is that EOS? Is that Hashgraph? Is that Bitcoin? Is it something that hasn't been created? I don't know. I don't really care. I think that the beauty of this blockchain is it doesn't need to have the levels of security, the immutability, etc., that traditional blockchains have. And what I mean by that is, take an example where I have a company, I issue a token, you invest in that token, right? Or I'll actually give you an example. So we tokenized an Inc. 500 company. I think some of the executives are here. It's a company my father's CEO of, and what we essentially did was we took the paper shares and we one-for-one swapped them into digital tokens, right? So if you held 100 shares, you now have 100 digital tokens, nothing else changes for you, right? It's not really that groundbreaking, but what it empowers us to do is to go raise capital, right, and do a whole bunch of things around the transactions of those shares. That's pretty important. Well, if you hold 100 of those digital tokens and somebody steals them from you, or you lose your private key, if that was Bitcoin, you're screwed, right? Well, here what you actually do is in the security token space, you're actually able to write in cancellation methodology, reissuance methodology, etc. And so what it does is it actually becomes a huge deterrent to crime, right? Because now all of a sudden, if I know whatever I steal from you can just basically be canceled out and it's going to get reissued to you, it's not really that attractive. And so the blockchains are a little bit different than these, but there will be one, and I think everyone will agree on it, and we'll be off to the races.
So obviously we know, like, we've seen your viruses spreading tweets and all the hashtags going around, it's kind of become a meme, but at the same time, would utility or security tokens be better off in the future, in your opinion?
So just so we're clear, utility tokens are bullshit, right? Utility token is a name that somebody came up for unregistered security. It is, right? Guess what utility tokens really are? They're points, badges, and streaks from the technology world. That's all it is, right? It's a gift card. We have a bunch of other names for these utility tokens. Now, the idea of the token, right, the underlying technology is different. All it is an incentive mechanism within a network, right? And so we try to put all this shine on top of these things. If you want to create a network and you want to incentivize people, there's a lot of different ways, right? So I tell founders all the time, you can use points, badges, streaks, tokens, whatever you want, gift cards, money, whatever. The problem that people are running into is they are trying to use the utility token as a fundraising mechanism. You will not get in trouble if you create a network and today you just say, look, when you come into my system, I'm going to give you a bunch of tokens and then you can use it as an incentive mechanism within the network. But humans are greedy, and rather than take the time to go raise money from traditional investors or crowdfund through regulatory compliant means, they're trying to issue these ICOs, right? Well, that's an unregistered security, and so as we've already seen, they've gone after the fraudulent folks. They're going to go after people in a way that I think we're not ready for. And I think that they're going to put a couple of people, they're going to make an example of them, whether they put them in jail or do something else, we'll see. But the utility token market is, tell me a utility token right now that's being used in any real way other than speculation. None, right? Tell me a utility token that's going to be used in any real way with 1 billion users, right? 1 billion users in the next 5 years. 0. Right? It's not real. But again, I don't think Bitcoin's really that important to the world yet. When 1 billion people use it, it'll be important, right? So we'll see.
Okay. Next question?
Yeah, I have a question. You're talking about making regulators proactive. And what do you mean by that, and how has your experience been here in North Carolina and what you're doing? It sounds like you're accelerating pace of the way the value can be transferred, which I think is a good thing, but what are some of the stumbling blocks? And then back to the original, like making regulators proactive.
Yeah, so in the most respectful way, I'm not worried about the state regulators, right? We live in a global world, and we're trying to transact on a global basis, and so the individuals that you need to worry about are the people who run the U.S. securities law and the individuals who run other jurisdictions where you like to raise capital. And when you talk about being proactive, what I mean is you get in a position where rather than allow somebody to do something that's not compliant and then go and force on them, right? It's a pretty inefficient process. If I can just use technology to stop you from doing that in the beginning, it's a pretty good idea, right? And I always joke around people and say, like, bars on a window is like a prevention tool. Like, you can't get in the window, right? Like, that's a pretty good investment up front rather than having to replace the window everyone keeps breaking into. Right? And so same thing here, it's just if you can prevent people from doing things that you know are non-compliant while they're doing it, we probably should invest the time to do that.
Good. We got another question over here.
Just yell. Yeah, you guys got them working out over there.
Gotta do some jogging. Get my Fitbit in. Sorry about that.
Thank you. So, I think we all realize retail investors can only take the cryptocurrency market capitalization so high.
Yep.
And everybody expects for institutional investors, smart money, to come into the space and push this into the trillions of dollars potentially.
It's not going to happen.
Yeah, so from your viewpoint, how do you see institutional money flowing into this space unless that these tokens are considered securities, or as you're saying, you're seeing assets or even stocks being considered as tokenized?
So I got a new saying. I used to say the virus is spreading. Now I just say smart money, don't gamble. Right? And what I mean by that is when you buy a utility token, what are you buying? You're not buying equity. You're not buying debt. You're not buying currency. You're buying air. Now, there's this idea that it should increase in value, but how is an institutional investor going to go back to their investment committee and say, hey, we're going to go buy air? Like, shit, I got jars of air, I'll sell you, right? Like, the key, I think, is that institutional investors, they're not in the game of taking risk, they're in the game of mitigating risk. So whereas retail investors ask, how high can it go? Institutional investors ask, how low can it go? Right? It's a huge difference because while retail investors are playing with thousands, tens of thousands, maybe hundreds of thousands of dollars, institutional investors are playing with hundreds of millions or billions of dollars. So institutional investors, they target anywhere between 6 to 8% annualized returns. Every single person here is a retail investor is absolutely bored by that. Right? It's like watching, anybody watch CNBC and they talk about like gold going up or down 0.5%? It's like, what are you guys talking about, right? It's nuts. And so what ends up happening is they've got to be able to put large amounts of capital to work, and they've got to be able to drive a return that is 6 to 8 or more, right? It is the target. And so where are they going to go do that? Well, they're not going to go bet the farm on these highly speculative, very volatile assets because they don't know the floor of the investment. But if you tell them, hey, you can go buy that piece of, that real estate building, right, or that equity in that company, and I can actually underwrite the risk, that's much more interesting to them, and they'll use the technology. Right? So they don't look at it as, hey, I'm making a blockchain investment, they're making a real estate investment. And so that's how they're going to come into the market, right? Obviously we've spent enough time with a lot of these institutions where the interest level in the cryptocurrency stuff is very, very minimal, right? They'll probably put some money into some sort of hedge fund or something, right, that's professionally managed, and they'll get some exposure that way. But we're talking about single digit, maybe low double digit basis points of their portfolio, which just isn't a lot of money. But if you walk in and the institution can only write a $150 million check, well, that's not going into Bitcoin, right? That's not going into the utility token market. How do I buy real estate? That sounds interesting, right? And if all of a sudden you tell them, by the way, not only can you go buy that same asset that you're used to buying, but you can do it in a way that you have a liquid position, and I can drive something higher than 8%, I can drive 15, 20, 30% premium. Now they're paying attention, right? So I think that's the type of stuff that people, when they talk about these institutional investors coming into the market, it's just from a rational standpoint, makes zero sense given the risk return profile they're looking for. And then here's the part that I did not realize before I started talking to these people. How many of you here in your job, if your company makes more money, you make more money? Actually, no one's going to raise their hand because they're all scared of that question. But there's not very many people, right? Now, some money managers, that's how they make money. The more money they make for their investors, they make more money. And institutional organizations, that's not how it works. So there's no financial incentive for them to take more risk. But if they lose money, they get fired. So that's why they think about, oh, if I make a mistake, I'm going to get fired, and if I get an extra 2, 3, 5% return, nothing happening. Great. I don't personally benefit. So all these little aspects of the institutional investor mindset and kind of risk-reward profile just changes, I think, how they're going to allocate capital in the space where people are, they're hoping that they're going to come into the utility token market, but I just don't see it happening.
Okay, and I got questions queuing up here. I'm supposed to throw this up here.
Hey, are you bullish on smart contracts disrupting business-to-business transactions, kind of outside of the cryptocurrency space, just an actual smart contract replacing a traditional contract?
Yeah, I mean, we've got various examples of smart contracts over time, right? So, I would argue that one of the earliest versions of the smart contract on the internet is like a terms of service. When you click a button, it gives you access to a platform, and you're agreeing to those terms of service, and then it gives you access. Is that a smart contract? I don't really know if it matters what you call it, but that's a version of a smart contract. If you do this, then you get X, right? And so I think that over time that's going to evolve. The human-written smart contracts are, I think, a stepping stone. What becomes much, much more interesting is when you have machines that are able to create smart contracts in some sort of very fluid way where humans aren't even involved, right? And so if all of a sudden, how many people in here are salespeople? All right, how many people in here pretty much know the list of folks that need the service that they sell and the general sales cycle? Most salespeople, right? Well, eventually machines are just going to sell to machines, right? There's technical specifications, there's certain needs, there's certain things that you can deliver, and the machines are just going to play matchmaker, right? There's no longer going to be a human on the other end that you're going to have to wine and dine to make the decision. Now, that might be 50 years away, right? Maybe 100 years. I mean, who knows how far away that is? But it's all that's smart contract driven. And so I think that that's, one of the really big innovations here. But again, everyone's, look, here's one of the biggest things I can tell a room like this. You're buying, if you're a retail investor and you're speculating in this market, you're buying and selling penny stocks. That's what you're doing. I ask people all the time, I say, explain to me what you hold in your cryptocurrency portfolio. I might as well put you in a movie and we'll just make fun of you, right? Because people are like, oh, I heard this coin's hot. I'm like, what? Right? Now, if you know that you're gambling, that's fine, but these people think they're investing. You're not investing, you're speculating, which again is fine if that's what you're okay doing, but I think that that's what is distracting everyone. They're not paying attention to tokenized securities, smart contracts, etc. And so as these people are continuing to do that, well, last November, December, everyone thought they were geniuses. I don't see so many geniuses anymore, right? How many people are down 60, 80% in their portfolios, and now it's something like, I don't want to play with that toy anymore, right? And so I think that we're going to see this constant parabolic run and these cutbacks. which are healthy for the market, but really where we should be focused around these tokenized securities, smart contracts, etc.
Okay, so with unregistered securities versus registered securities, when was it officially that unregistered securities became illegal to buy and sell in the open market? Because I look at the current legislation, you can still have unregistered securities, it just needs to be distributed amongst employees in some special way. But was it the SEC that made that illegal, that you can't have unregistered securities for sale in the open market? Because that was not always that way in America.
Yes, so again, there's multiple layers to that question, right? One is, you gotta look at what the regulator's job is. The regulator's job is to protect retail investors, right? The regulators really don't give a shit if your company is successful or not. Now, they would like you to be successful, right? Because if all the issuers go away, or the regulations don't serve the need of you, you're gonna go somewhere else, right? So like, here's the sobering moment when it comes to all the regulatory stuff. If the regulators fuck up, the market will tell them, because everyone will go to a different country. Right? And so, maybe. I think that there's a lot of people who wish that they were doing this in the United States, though. Right? So, we'll see how that plays out. Now, on top of that, if you look out at how, I'm an advisor to one company, right, in the cryptocurrency utility space. And what they did was they created a bunch of tokens and they directly listed onto the Stellar network. So no fundraise. And what they said was, you can come onto these exchanges and you can buy our tokens. The only thing that you can use this token for is to give it to one of our partner charities. So they went and partnered with STEM.org, Girls Who Code, etc. And when you give that token to the charity, we have a treasury, and we'll match dollar for dollar everything that you donate until we run out of treasury, right? So what you're doing is there's no fundraise. They directly listed. You come in and you buy. You have no expectation of it going up in value. Instead, you're actually giving it away, right? Well, is that an unregistered security? Well, it sure is selling a security, right? It's basically a gift card. It's like going on Amazon, buying an Amazon gift card, then you give it to a charity, right? And then Amazon would match dollar for dollar. So is that interesting to most of the world? No, right? So I think that what we're getting into is we're trying to, like people are saying, like, there is a way to raise capital, right? That's what everyone's running into this space for. They want the ICO, they want to raise capital. Well, the reason why they're doing that is because most of them can't raise capital other ways. There's a lot of people who can, right? So I don't want to say that everyone has that company, bad idea, etc. But in most cases, if you look at the people conducting these ICOs, they're not able to raise capital in other means, or it would take too long, etc. And so it's a shortcut, right? As we know, shortcuts only last for so long. Some people get lucky, and some people get burned. And so again, it's just not sustainable. And I think what we're going to see is this idea of the tokenized security is a legal way to do the ICO. Right? It's fundraise. You're selling tokens. The difference is, what do you get as an investor for putting your capital in, and how you market it, it's structured, who you market it to, etc. Well, those rules are in place for a reason, right? So people always ask me, like, what laws would I change if I change anything? Well, let's change the accreditation law. Right? The idea that I have to tell people when I'm selling them sounds like a pretty reasonable law to me, right? The idea that I have certain ways that I can market it to you so that it's not, kind of scammy, pretty reasonable law. The thing that I disagree with is this idea that the people who can invest, it's not based on their sophistication level, it's based on their means. So literally, by definition of that law, the rich have an ability to get richer when the non-rich do not, right? And so, I'm not one of these anarchists, etc., but I think that there's a very real argument to be had there in terms of, why do we have this accreditation law that's based on financial needs and not sophistication? Why don't we have a financial test, right? If you pass the test, you're able to invest. Why don't we do what some countries in Europe do, where there's an opt-in of sophistication? You basically, I don't know how many of you are familiar with this, but in Europe you can basically say, I'm a sophisticated investor. And if you're sophisticated, you can invest in almost anything, but there's very, very little consumer retail investor protections. You can opt in and say, I'm a non-sophisticated investor, and they drastically shrink the number of things that you're able to invest in, but they increase the amount of protections you have. But it's on you. And so if you're dumb and say that you're a sophisticated investor and you get screwed, well, you probably should have said you were not sophisticated. That's a much more reasonable approach to me than based on financial means. But again, I'm not a regulator. I don't want to be one, and frankly, we'll just wait till they tell us what the rules are, and we'll go play by the rules.
Okay. Any other questions? I think we got time for one more.
I see they moving the clock here. Just restarting.
Well, yeah, that one. I think we got the other one back there too. So I think we got 3 minutes. Oh, did you?
I'll stand here for 10 more minutes, and then I'm even.
Thanks. Can you give us some examples of companies that are already doing this? And another question is liquid asset token or LA token an example of a company that would, because they're tokenizing assets like oil and artwork?
Yeah, so I'll stay away from commenting on them. I don't know anything about them. I'll give you 3 examples. So one is an XCO here in Raleigh. It's a company that we tokenized. Again, all they did was they took a paper share certificate, one-for-one swap to the digital tokens. They're now conducting a fundraise, right? And as long as you're an accredited investor in the U.S., you can invest. You don't have to be, the key here is everyone says, it's only available to accredited investors, right? And so that sounds like, it's still the same system. But what I say is, again, this technology is not revolutionary, it's an evolution, right? And so previously, if you wanted to invest in that company, you had to be a venture capitalist, you had to be a private equity investor, you had to be a bank, right? Or you had to be somebody who was incredibly well connected. Well now, as long as you have an internet connection and you come across the discovery of this opportunity, right, and you fit within those qualifications, you can invest your capital. It's very similar to what AngelList did for early stage investing, right? Venture capitalists still run that market, right? But now you're just slowly opening up the participation for other people to come in. You're not going to completely rip the Band-Aid off, right? But you're slowly chipping away at it. So I think that's one. Another example is JD Financial. JD Financial is like one of the top 200 largest companies in the world. They just announced yesterday that they're going to start issuing these asset-backed tokens. It's a pretty big deal, right? And a third example is a company, Swarm. So Swarm's based out of Silicon Valley. What they did is they basically have these legal entities that hold shares in Coinbase, Ripple, Robinhood, and Didi. And so in a secondary transaction, what essentially happens is if I'm an investor in Coinbase and I want to transact with you, I got to go to the company and get approval. But what the secondary market has figured out is if I invest in the company and I hold those shares in a LLC, rather than try to move the securities, because then the cap table would change. Instead, what I do is I just sell you equity in my LLC. So you're not technically holding the securities, but you own the legal entity, or you're a partner of the legal entity that holds the shares, right? And I don't have to go get approval from the company. So what these guys have done is they basically tokenize the LLC. So they can't tokenize equity of somebody else's company, but they tokenize the equity of their holding company that holds the shares. You can imagine the cease and desist were sent literally within hours. Like, people are freaking out. Well, we're watching disruption happen. I literally was, I don't know how many of you guys saw on Twitter that I was going at it with a securities attorney, and he keeps telling me he's got 2 law degrees. How the fuck do you have 2 law degrees? Like, it's almost like they cancel each other out, right? Like, how does that work? But then he's telling me he's a securities attorney, all stuff, and what I said to him is I said, listen, all of that's great. We're literally watching. Even people who are trained in this stuff, they don't understand the slight mechanism of, they're not tokenizing the security, they're tokenizing the holding company that holds the security. Well, why is everyone so upset about that? Because you just completely disrupted the company's ability to control who owns their securities. Now again, I'm not big on this, like, hey, let's go let a bunch of nefarious people do crazy stuff and build derivatives markets on top of derivatives markets, all that crazy stuff. But I do think that it's really important that somebody who isn't well connected in Silicon Valley, New York City, have the ability to invest in companies if they want, right? Now, ultimately what I think is these companies are going to be forced to do this. So I actually think the regulators are going to mandate the technology because it allows them the advantages they have. And then I think also what you're going to see is the exchanges, right? So if you look at New York Stock Exchange, NASDAQ, like, they're pretty innovative. But most people don't know this. New York Stock Exchange is one of the first investors in Coinbase. Why? It's a hedge. Well, if this thing becomes big, I'd like to have some financial, like, if they're going to kill us, at least let's go down and, some money in our pocket, right? So I think that's what you're going to start to see. If you look back at like the great browser wars or the Apple's versus Microsoft, over the next 20 years, I think the big battle in technology is going to be the battle between Coinbase, Circle, Robinhood, and the existing exchanges. Right? So we'll see how that goes.
Okay. Well, thank you, Anthony.
Nobody else? All right, thanks, guys.
Thank you very much.